Hello, and thank you for joining us today. I'm Mary Collins White, and I lead CrowdStreet's member relations team. Before we get started, I do have a condensed disclaimer to read, so please listen carefully. CrowdStreet Inc. offers investment opportunities on its platform. Broker-dealer services are offered through CrowdStreet Capital, a registered broker-dealer. Today's webinar is educational in nature and should not be construed as an investment recommendation or advice, or as an offer to sell, or the solicitation of an offer to buy an investment. There are risks associated with investing in private equity real estate, and you should consider seeking legal and tax counsel prior to investing. Please also note that past performance does not guarantee future results. And finally, this presentation is for informational purposes only. I'm joined today by two of CrowdStreet's most experienced CRE professionals. Anna Marie Allender-Loeb is an executive managing director of CRE Investments. She joined CrowdStreet in 2015 and is a key member of the Offering Review Committee, where she plays a crucial role in offering structures and ensuring regulatory compliance. Prior to joining CrowdStreet, Anna Marie was with PNC, where she specialized in underwriting and structuring innovative tax credit equity and debt financing solutions for historic tax credit and low-income housing tax credit investments. Anna Marie started her real estate career in Boston, where she was a member of the CBRE New England Capital Markets team. She earned a degree in economics from the Wharton School of the University of Pennsylvania. Charles George, better known as Chip, is a director and portfolio manager at CrowdStreet and is a member of the CrowdStreet Advisors Investment Committee. Chip has over 40 years of CRE experience, and prior to joining CrowdStreet was a portfolio manager for institutional advisors at firms including Reef America DWS and Harrison Street Real Estate Capital. He's a graduate of Miami University. Anna Marie is going to start off our discussion with the macro discussion, and then we'll shift into updates on the current market environment and specific asset types, ending with the discussion of current market themes and activity. We'll ask that you submit any questions via the Q&A button on the Zoom screen, and we'll get to as many as we can at the end of the session. And with that, I will turn things over to Anna Marie.
Great. Thank you, Mary, for the great introduction, and hello, everyone. As Mary mentioned, I'm Anna Marie Allender-Loeb. I'm Executive Managing Director for Commercial Real Estate Investment, and I'm very excited to be joined today by my colleague Chip George to provide what I hope will be an insightful overview of what is happening in the broader commercial real estate landscape. Again, before diving into the individual asset classes, as Mary mentioned, we thought it would be prudent to maybe take a step back and walk through the current macroeconomic environment. So let's jump in and begin with where we started the year, right? So back in January, the US economy was really riding a wave of cautious optimism. Inflation had cooled, consumer demand was steady, and markets were pricing in what most would consider a soft landing. Then, of course, came the Liberation Day tariffs, really a bold policy experiment that triggered swift retaliation and rattled the financial markets. The result, a contraction in GDP of about 0.5 percentage point in Q1, and a sharp pivot in investor sentiment. Fast forward to today, and the economy really has shown resilience, but the picture is a bit mixed. So let's walk through some of those key signals. GDP rebounded and saw 3% growth in Q2, which was encouraging, but the full year projection is softened to around 1.7%. Job creation has slowed dramatically, right? Just 35,000 new jobs per month on average over the last quarter. Further, data that came out on Friday show that the US job growth weakened sharply in August, and the unemployment rate rose to a near 4-year high of 4.3%. Retail sales, though, remain strong. July saw a 0.5% increase in month-over-month growth and nearly 4% year-over-year for July. Treasury yields have come down slightly. The 10-year now sits at about 4.1% as of close yesterday. And it's really the lowest level we've seen since April. But let's not forget, right? This is still quite a bit higher than the sub 2% yields we saw kind of during that free money era in 2020 to 2022. But this recent decrease, may reflect that investor expectations are that we should see some policy easing coming ahead. Speaking of policy, as I mentioned, markets are now pricing about, call it close to a 90% chance of a 25 basis point reduction at the Fed's upcoming September meeting. So what does all this mean, right? Policymakers, I would say, are caught in a bit of a bind, right? Should they cut rates to support employment in the face of weaker exports or raise them to counteract inflation from the elevated tariffs? So far, right, inflation pass-through has been muted, but the full cost of those tariffs hasn't really quite worked its way through the system yet. I think for commercial real estate, right, the volatility that we've seen is likely going to continue for some time, right? There's still going to be uncertainty in the markets moving forward. So it's going to be important, I think, to focus on some of those longer term fundamentals, get back to basics, thinking and looking at things like demographic shifts, regional growth, and supply constraints as we're looking at different asset classes and potential opportunities. But Chip, I'll pass it over to you. I know you're seeing a lot of kind of these impacts on a daily basis as you're kind of working through the existing portfolio of deals that have been on the CrowdStreet marketplace. I know especially we're kind of feeling a bit of the interest rate expansion that we've gone through here. I'm sure you have some thoughts to add. And I know you're also kind of walk us through kind of how all this is impacting transaction volumes as of recent.
Yeah, thanks, Anna Marie, and thank you everybody for being here today. I guess I'd like to just focus on the lower right-hand chart just for a second, and just what this illustrates is the darker line is the federal funds rate, and you can see how that dropped down in 2000 to 0% essentially. So for a couple of years, and that's one of the things that we're going to be talking about today more and more, just how it has impacted the real estate market. And then the green line represents the treasury marks. Then in late 2022, you can see how the federal funds rate started rising dramatically. So it rose 500 basis points from 0 up to 5%. And then there's been some moderation over the last year. And as Anne Marie just said, we're expecting a little bit more coming forward. I guess that's the sentiment, which should ease a little bit of the pain. So if we can move forward to the next slide. And now, thank you. So I'm just gonna touch a little bit on transaction volumes that we're experiencing. Again, the chart on the right-hand side, this is 10 years of activity since 2014 through 2025 on a quarterly basis. You can see leading up to COVID, pretty steady, even a little bit of up and down transaction volume. And then you can see the impact of COVID when we went drastically down for a couple of quarters when the markets essentially stood pretty still. Then what you can see over the next series of quarters is the impact of the lower interest rates when you could borrow money at 3%, roughly 3% over the SOFR rate, which was close to 0. So, and during this period of time, CrowdStreet, we did a tremendous amount of activity. This was we were raising record amounts of capital, and there was record amounts of capital being invested into the industry. Then what you see on the right-hand side of the chart is the impact of when the rates started increasing. And you can see pretty much an immediate drastic decline. But I would say over the next few quarters, you can see a little bit of an upward trend. And so that's what we're seeing. So as far as transaction volume, there's one large transaction that's excluded from these numbers. It was a $10 billion transaction last year, but volumes overall are up about 13% year over year, quarter over quarter. So this is still, while improving, it's still below the pre-COVID averages. And the activity is up in all sectors. Multifamily leading the way with the 7% year over year increase in activity. Industrial is the first half of the year was 2% year over year, so much lower, but still in a positive way. And then really very large increases in the office and retail sectors. But this is coming off of what I'll call an extremely low amount of activity in the 23-24 timeframe. Okay. So Anne Marie, I will push it back to you. We can talk about multifamily.
Yeah, let's do it. All right. So I think when we think of multifamily, I would say that right now it feels like we're at a pivotal moment for the U.S. apartment market, right? After several years of supply really outpacing demand, it feels like the balance is starting to shift. By the fourth quarter of this year, annual net absorption is projected to exceed net deliveries. This is going to be the first time we're going to see this since 2022. And that's a meaningful turning point. And it's already starting to show up in the data. Vacancy compression is accelerating. So in the third quarter, overall vacancy had fallen to 8.1%, and it's forecasted to dip below 8% by year end. What's driving this? Again, it's a combination, I would say, of resilient renter demand and a shrinking construction pipeline. But more specifically, we've seen that the 4 and 5-star apartment segment has kind of been leading this charge somewhat. Absorption in these higher quality buildings has outpaced supply growth at this point. It's pushing vacancy down from a peak of what we saw at 11.8%. It's come down to 10.9%, with further declines expected through the end of this year. Overall, I'd say demand remains strong. In Q2 alone, we saw absorption of 140,000 units. This was the 6th consecutive quarter that we saw above 100,000 units, with markets like New York, Dallas, and Atlanta kind of leading the way here. I think demographics also remain a bit of a tailwind for multifamily, right? We've got the older Gen Z renters that are entering kind of a prime leasing age. And also we're seeing that baby boomers are actually increasingly opting to rent again, which are both trends that kind of support some continued demand in the space. On the supply side, the development cycle has clearly peaked. Net deliveries fell 30% year over year, dropping below 145 units in Q2. And the pipeline really is thinning fast. By Q4, forecasted completions will be below 75,000 units, which is just a dramatic slowdown from what we've seen recently. Construction starts are now at a decade low. This is driven by extended lease-up periods, higher capital costs, and really tightening of lending standards, which we'll talk a little bit about development again later in this presentation as well and dive into that a bit deeper. But this really means that, right, there's just fewer new units coming online, and there's really more pressure on that existing inventory to meet current demand. As we look ahead, absorption is expected to continue chipping away at elevated vacancy rates. We're on track to fall below about 7.75% by Q4 of 2026. But there's also a bit of an important nuance to point out that while overall vacancy is declining, stabilized vacancy, so that's the rate that you would see in kind of a fully leased mature property, is forecasted to actually increase through 2027. And this really reflects some of that lingering supply overhang from the past 2 years, right? It takes time for buildings to lease up once they're constructed, and that's kind of what's causing that effect there. So this divergence really suggests that rent growth is going to improve gradually. It's not going to explosively turn around, right? It's going to be a slow kind of recovery here in multifamily. But by year end, it is expected that year over year rent growth is going to increase to about 1.5% nationally. I think overall, we're really just entering a phase where demand is outpacing supply, vacancy is starting to compress, and rent growth is beginning to reaccelerate. Again, with construction starts at historic lows, financing still relatively tight. I think the next 12 months really presents a moment to kind of lean into fundamentals and prepare for a more balanced environment where really pricing discipline seems to have returned to the market, which kind of has been reflected by cap rates, which are sitting, I think the most recent cap rate observer by Green Street said for multifamily nationally, cap rates are around 5.2%, which again, it's up from kind of the crazy, I would say, 4 to sub 4% we kind of saw during that free money era of like 2020 through 2022. So that's kind of my thoughts on multifamily. Chip, I don't know if you have anything to add. Otherwise, I'll pass it to you to go over
I
industrial.
think we can move on to the industrial sector. So I'm going to touch on the industrial or warehousing sector. This has been the top performing sector over the last 10 years, kind of by far. This has been really driven largely by the explosion in e-commerce, the whole Amazon effect. I know at our house, Amazon comes almost every day, as well as the international trade. So this has been a huge performing sector, a lot of new construction over the last decade, and much of it has been been rapidly absorbed, and rental rates have been just steadily increasing. Recently, however, we've been seeing a slowdown in activity, and the chart on the right illustrates that. You can see the blue is new deliveries and the orange is absorption. So we're seeing continued new deliveries of space and a lesser level of absorption. And then the green indicates vacancy, the green line. And so, as you can see, a little bit of over the last couple of quarters, the trend has been upward. So after really dramatic activity over the last 10 years, we're starting to see a little bit of a slowdown. So right now, vacancy is up to 7.4%, which is the record high, or at least the highest it's been over the last decade. And we're forecasting, frankly, a little bit of additional vacancy as this additional supply gets delivered over the next year. Bottom line, supply is outpacing demand, which is causing a little bit of the imbalance we're seeing in the market. And as a result, rental rates are flattening. This is the lowest level of rent growth we've seen also over the last 10 years. Rents have been dramatically increasing. And what's driving the slowdown in demand? It's something we've seen a lot in the news lately. The whole discussion on tariffs, that is creating quite a bit of uncertainty. Not only from the taxation, but the whole e-commerce industry is really, I think, being more impacted by uncertainty. I know in our portfolio, we're seeing a lot of tenants that are looking at space, they're considering space, but they're slow on pulling the trigger to commit to a longer term lease. And it's really, primarily driven directly by the uncertainty over the tariff situation. I think as that situation becomes, better known, I think hopefully we'll see some of that activity increase again. As far as the segment divergence, one of the things we're seeing is quite a difference in how smaller older warehouses are compared to the big, new, very large buildings. So what we refer to as small bay, which are buildings with tenants under 50,000 square feet, the markets are actually very tight, about 5% vacancy with really strong renewal activity. Not a lot of this kind of space has been built over the last number of years. Most of the product tends to be older. And then the logistics space, these are the big, huge warehouses, 100,000 to 500,000 feet, even higher. That's where we're seeing a little bit of the softness in the market, where vacancies are, approximately 10%. Just again, a little bit of oversupply there. Okay, that's all I have on industrial.
All right. I had a couple of points I can add just before we dive into retail that kind of stood out to me. I think one, negotiating power in industrial, I think it seems to have shifted right now towards the tenants. Right as you mentioned, quarterly rent growth dipped into negative territory. Spaces are just sitting longer on the market, and kind of that medium time to market has nearly doubled since pre-pandemic. I'd also add that despite some of the current softness in industrial, we're still seeing many leases that are renewing at higher rates, just due to on renewals, right? Just due to kind of that incredible rent increase we saw during the pandemic era, right? So this also is especially true kind of in that small bay market with the tight fundamentals that Chip was talking about. But with that, let's jump into retail. All right. So the retail market, I would say, is really navigating a period of recalibration. The aftershocks from late 2024 and early Q1 2025, that was kind of marked by a wave of bankruptcies and store closures in the retail space. Think of things like Joann Fabrics. They announced over 500 plus store closures in 2025 so far. These are still unfolding a bit, and it's really leaving a visible imprint on kind of the leasing dynamics and space availability within the retail sector, right? We saw negative absorption in Q2 2025, which signals kind of the second straight quarter of contraction here. Retailers continue to shed space, and while that pace of outflows has been notable, it is expected to moderate in the coming months, assuming kind of no new major failures emerge. Availability rose by about 7 million square feet in Q2, pushing total available space to a 3-year high. It is worth noting that availability remains nearly about 15% below the 10-year average, though, which really underscores the sector's long-term tightening and the resilience of its fundamentals. Amid these headwinds, leasing activity remains surprisingly robust, right? Backfill demand is strong, with new leasing reaching its highest levels in terms of what we've seen over the past 3 years. The median lease-up time now stands at about 7.3 months, which is a 15-year low. For higher quality spaces, that timeline is even more compressed, falling under 5 months. But there's a bit of a catch. So if we look at kind of the retail sector as a whole, there's about only less than 25% of that available space is rated kind of 4 and 5 star, and nearly 60% of the inventory is over 40 years old. So in short, right, high quality space is just increasingly scarce. So what's driving demand within retail? We've seen a clear shift in consumer behavior for the first time on record. Services and experience account for the majority of lease space. Tenants like restaurants, fitness studios, and health services are really outpacing traditional goods-based retailers, right? And I think that just kind of goes to show, right? People are purchasing things in that online kind of e-commerce environment. But again, the services, you still need to go be there in person. That's kind of what's driving a lot of the tenant demand in retail right now. And again, right, categories like pharmacies, department stores, facing less space than they have historically. So that's just kind of that trend that we're seeing. On the rent front, growth is definitely slowing, but it's still holding near multi-decade highs with a 0.9 over year increase reported in the quarter. I think looking ahead, the market faces continued downside pressures as the final wave of closures kind of works through the system. However, a combination of low availability, tenant and minimal new supply should help limit vacancy expansion. Overall, the sector's kind of supply constrained nature and the ongoing shift toward service and experience-based retail continue to support expectations within the space. All right. With that, I'll pass it to Chip to talk through office.
Yeah. So the office sector, I think it's pretty well reported, but this continues to be the sector that really is experiencing the most stress, both operationally and then as continued as a result financially. A lot of the downturn in office is related to the post-COVID work from home environment where tenants just aren't using the space as they were pre-COVID 2019 and before. Also, there's been really the downtown CBDs are not being utilized nearly as much. There's a movement away from going downtown to work as opposed to the pre-COVID timeframe. And as a result of this, overall vacancy is now nationally at about 19%, and there's really a divergence between your prime Class A space and then your lower quality, older building, maybe not as well located Class B and C buildings. So the A space is about 14.5%. So, and then you can see the BC is almost 20%. But these are the highest vacancies that we have experienced, on record. And the trends really are not positive. The trends continue in office to be when leases come up, tenants, they may renew their lease, but they may downsize a little bit, take a little less space than they had before. And so we see that trend probably continuing for a couple of years until there's a bit of a change in the way users use space. There is a little bit, we're seeing a little bit of a return to office trend, which is showing some positive momentum, but hybrid work, where employees are going into the office 2 or 3 days a week. There's certain pockets that are actually of the office market that are performing better than others. Florida, for whatever reason, is actually the markets are pretty strong down there, and they're clearly outperforming some of the larger cities in the northern part of the country. The good news about office, very little new space is being delivered. So not a lot of new supply constraints coming on. Much of the new space, frankly, is already leased. It's, you know, it's corporate build-to-suits and things like that. So not a lot of new activity. As I mentioned, the average lease is getting smaller, probably down about 15%. So on average, that's the type of square footage tenants are giving back when they renew space. And really for the next couple of years, we're expecting minimal growth in absorption as well as in rent growth. Your Class A, your newer buildings are doing well, so there's a real flight to quality, and the BC buildings really are under some stress and with high vacancies and really no demand for their space. What's maybe an interesting byproduct of this is maybe that second tier space. These are A buildings, but they're not in what you would consider that top tier property. What we're seeing is a lot of increase in capital expense budgets. And what they're doing is adding amenities to really bring these up to the top tier. So they're building conference centers and lounges for the tenants, fitness centers, food services, Wi-Fi throughout the building. So they're adding a lot of amenities that make these buildings attractive in today's marketplace, which is a tough market. And I think nobody expected this or saw this coming, but from an investment standpoint, clearly this is the least popular. It's really tough to sell any building, especially if it has speculative leasing needed. Okay, Anna Marie.
All right, should we jump into development? All right. So development, I think right now it's safe to say that the development landscape, I would say, is defined by caution, recalibration, and just a notable shift in the momentum we saw kind of in the early 2020s. Developers are really navigating a complex mix of elevated costs, muted returns, and tighter capital conditions overall, which are just shaping kind of the feasibility and pace of new projects. Right. First, construction cost inflation just remains such a huge headwind. According to Mortensen's cost index, prices rose by about 5.42% year over year in Q2, again, driven by persistent tariffs, rising material costs, and labor shortages. While some supply chain pressures have eased, the cumulative impact continues to push project budgets higher and timelines longer. On the financing front, right, we've discussed interest rates and how they just have not declined as quickly as many initially anticipated earlier this year. I think despite the Fed's easing cycle in late 2024, the cost of leverage is just elevated still, and lenders are really maintaining a conservative underwriting standards kind of moving forward. And this really has just created a capital environment where the most compelling kind of risk mitigated projects are moving forward at this point. I think similarly, as we've kind of discussed, as we covered the asset classes here, right, rent growth across kind of all asset types really remains flat to modest, which really limits some of that upside for developers as they're creating, it's just creating an environment with compressed margins for them, which is further compounded by slower lease-up velocity. And this has just made underwriting much more challenging, especially for speculative development. But I think perhaps the most telling is, right, the shrinking of the construction pipeline, right? You can see on the charts here, just kind of that shut off on new supply, and these are showing deliveries, right? So they're going to lag a bit of the actual construction pipeline, but it just really has been shut off to kind of these reasons that we've gone over. It's probably expected the same that these deliveries are projected to remain low for the foreseeable future, with, I'd say, the exception of retail, which you can see kind of spikes back up to kind of the historic norms. But that was just a sector that probably wasn't as overbuilt as some of the others. So I think overall, investors are just kind of pulling back amid this cost uncertainty and tighter capital. The supply discipline is probably going to help stabilize fundamentals over the long term, but I think in the near term, it just kind of reflects a market that's a little bit on pause mode when it comes to putting out new product. I don't know, Chip, if you have anything to add. If not, we can kind of jump
Yeah,
into.
I'm going to touch on the development in the next section a little bit.
Yeah, so let's jump in and kind of talk to some of the insights from the broader kind of CrowdStreet.
Yeah.
Yeah.
So again, yeah, this is just, some of the themes we're seeing across our portfolio. So we have a pretty wide, a broad portfolio in all product types all across the country. So we still have over 500 active deals on the CrowdStreet platform. We've had over 250 realize. What we're seeing is because of the issues we've been talking about, we're seeing challenging market conditions that are really expected to persist into 2026. You know, and the theme we're seeing, continuous, which we'll repeat, is the impact of the rising interest rates. The projects that we have that were financed with fixed rate debt, longer term leases in place, longer term debt, really those are performing as underwritten. So it's the projects that we're running into primarily in the 2021-22 vintage years where we're seeing some financial and operating stress. And these are projects with higher levels of leverage. And this is where we're seeing it with primarily floating rate debt as well. This is where we're tending to see a lot of the stress, a lot of the capital activity, which we'll get into in a minute. And so right now, as these projects are, just as an example, if a project was done in 2021, it had a 3-year loan in place with a variable rate, but a rate cap in place, like an insurance policy that locked in that rate. What we're experiencing as 24 and 2025 come around is the sponsors are forced to refinance these loans, and we're now refinancing into a totally different economic environment. So we're seeing, the capital call activity that we've been seeing. And transaction volume right now, which we touched on earlier, is very depressed, as well as the valuations. So the values of these properties and the ability to sell them is very difficult. Either you can't sell it, or you wouldn't like the price if you saw it. It's in many situations at the debt level or sometimes even below. So that's not a great option. So what sponsors want to do is hold on to these properties and wait for a better economic market to sell into. Okay. Another issue, which besides the refinancing with the higher interest rates, is because the loan to values have changed, valuations have changed. Many times, lenders are requiring a pay down of the loan balance. So not only are you faced with the impact of the higher interest rates, lenders are saying to renew this loan, we need you to pay down at least some portion of that loan to get our loan more in balance. So that is another factor causing this increase. As we talked about also earlier, the trend of interest rates, has been downward. They've already come down 100 basis points from the peak. There's a lot of sentiment in the market that they're going to come down 20 to 50 basis points in the near term, and maybe even a little more later in the year. So I think that will certainly improve the situation. And then there's I'll call it the last situation here, which we're starting to see more and more of, is the recapitalizations. So this typically is done when the lender is not willing to lend additional capital. We're not able to raise through our investor base the needed capital to keep this project alive. And then we call it rescue capital, but it's third-party investors that invest new money into the deal. And this is, this money that's coming in is expensive, and typically they can control some of the terms of the deal. They're oftentimes in a priority position. Sometimes they have approval rights on managing the project, major decisions. So we're seeing a little bit of that enter into the more challenged, the deals with higher levels of stress. Okay. Anything else here, Anne Marie?
Oh, I think you covered it.
Yeah. So what we thought we'd do is, one of the questions we get a lot of times from investors, across the board is, why are we having all these capital calls, and basically what is a capital call? And, simply stated, it's when a project is over budget or doesn't have enough cash to operate. And if there are no other sources, whether the lender or the general partner, or there's no other sources of capital, that the next call they make is to the investors in the deal for additional capital. And what's driving these capital calls? Well, on development deals, it's projects being over budgets. They're higher costs than were underwritten. And this could be the cost of materials, labor costs have gone up, supply chain issues where it's just challenging getting materials or getting things to the project site. And then unforeseen conditions, which we run into on any development project. These can add to the budget. Typical development project will have a contingency in place, but if we exceed that, we are over budget and we have to solve that problem. Also delays. We're seeing a lot of projects that are having maybe longer delays than were expected. This is driven, the supply chain is a real challenge getting utilities to projects, even switchgear that's coming from overseas, from China. There's been a big backlog on these that are delaying many of our multifamily projects. And just the municipal approval process. That's an unforeseen condition that we don't control. And oftentimes projects are taking much longer to get approved than was anticipated. We talked about interest rates a lot, but that's clearly a factor. Is the higher rates that are part of the project budget. We touched earlier also on the requirements to pay down a loan. Sometimes it's not a huge amount, but a lender will say, we'll renew or extend that loan, but we want you to pay down the loan by $2 or $3 million. And that becomes an added cost that the project needs to come up with those dollars. And then the other thing we're running into is just general market conditions. With the large amount of supply in all the markets over the last few years, we're seeing rents that are not growing as anticipated. We're seeing concessions, in the markets primarily because of the supply demand imbalance, where we're having to give away maybe a few months free on a lease in order to get that tenant to commit longer term. So we're getting hit in a few different directions with rents, concessions, as well as the vacancy rates might be a little higher than underwritten. And then on the expense side, we're seeing increases there as well. Just, dramatic change over the last several years that was not expected. One of the big ones is insurance costs, particularly in the Sunbelt markets, Texas, Florida, the Carolinas. We're seeing rents or insurance costs go up triple. They're 3 times the cost that was underwritten. So that's having a material impact. And just some of the other, line items, the real estate taxes, payroll expenses, just are, with the inflation we've experienced over the last few years, has been going up pretty substantially. So those issues are what are driving the needs for these capital calls. Okay. So that's all I have here. Anne Marie, Frida, or Mary, is there anything else?
Yeah, should we jump into the Q&A?
Yep, we've got a number of questions coming in. One, just picking up on what you were just talking about, Chip. How are lenders generally approaching maturing loans right now? You talked a little bit about requiring them to be paid down if they wanted to refinance, but are extensions and pay downs the norm now?
Yeah, I would say, I've been in this business a long time, so we went through a very similar time, circumstance back in the 1990s. And what's different about this cycle compared to prior cycles is in prior cycles, there was a lot of foreclosure activity. Lenders were very aggressively taking back properties. We had the whole what was known as the RTC, which was the government who were bailing out the savings loans, were taking back title to properties. This cycle, what we're seeing is lenders being much more open to modifying the loan, so to giving extensions. And then it becomes a negotiation. What they're trying to do is obviously improve their terms. They're trying to bring those interest rates up to market. They're trying to keep those loans in balance, which means the loan to value with their own internal underwriting. So that is what is driving the need. So overall, we're seeing lenders, yes, they're agreeable. They don't want to foreclose and take back title to these properties. It didn't go very well for them the last time around. So they're much more open to these modifications, which is why we're seeing so much capital call activity.
Yeah, I would add there, I was just looking at a recent report that TREP published that looked at maturities through 2020 through 2025, and about 1/3 of loans were not paid off at maturity during that period. This is up or increased from historically that was more like 20%. So definitely a step up there. And to your point, Chip, out of the ones that they kind of classified as in negotiation, kind of out of those ones that did not, get paid off on maturity. Right, 27 eventually in multifamily, 27% eventually were paid off, but 62% just remained kind of in that negotiation limbo as kind of owners were working with lenders to figure that out. For office, it was 49% that kind of was classified as unresolved, and retail 39. So that number is quite high in terms of lenders working with groups to see if it can be worked out versus kind of the actual losses that were noted ranged from, call it, 2 to 7%. Right. So,
Thank you. And we've got a number of questions in around how interest rates cuts affect the multifamily sector. One is how have they traditionally shaped performance during periods of rate cuts? What is multifamily? How do they react, and how does that impact cap rates as well?
sure. Well, right. If you look at multifamily, typically, the interesting thing about multifamily is you have agency loans, which is kind of long-term 10-year debt for stabilized properties, right? So many loans may have been locked in with a agency loan at a rate. The rates on these are typically following the 10-year treasury, which is going to, be based off the Fed funds rate. So it's usually a spread over the 10-year, which I think from our initial chart you can see kind of moves along with the Fed funds rate, but a bit higher. So it definitely is going to have an impact. I think what's interesting, I think what we saw was a lot of the value add deals. Groups are going to get a bridge loan, which is 2 to 3 year hold on that or term on that loan, and then they're going to have to refi into a new loan after those 3 years, or right, exit the deal and a new buyer is going to come in. I think what we saw through groups that entered into deals in 20 through 2022 at that kind of that lower lending environment didn't necessarily price in what was going to happen with interest rates going up. So just the valuations also associated with those loans is going to go down. The refi proceeds that they were expecting weren't there, and that's kind of where we're seeing those what we call cash in refis, just due to valuations having come down, call it 20 to 30% from peak pricing. So there's just a gap there to fill, plus more expensive debt that needs to come in.
Another question is around what we've learned over recent years, given the stress of the 2021 deals. How does this change how we evaluate deals today?
I'd say for the investments team, I think we're very focused on a few things. I think really understanding the capital stack, how things are capitalized, right, in terms of the debt. Not that we weren't looking at it before, but I think, obviously when rates are higher and not, near, low, the 10-year treasury was, sub 2%. Debt becomes more impactful. And I think the assumption that rates are going to stay elevated, going forward and not necessarily go back to that abnormal period is probably getting pulled in. And then I think also really paying attention to, rent and expense growth assumptions, right? I think right now, if you look at a deal, it's probably very realistic here in the near term that your expense growth is going to be above, right, your rent growth versus, call it back in 2022, there were situations where, we had seen rent growth of 10%, whereby expenses obviously were not growing by that measure. So those margins are just more compressed. There's less room for error. And so really paying attention to those things, running scenario analyses and understanding, okay, can a deal support today if nothing changes? And are we still going to be okay if that's the case moving forward? I think is kind of a good way to look at a deal.
Another one, and this is a question we get a lot in the member relations team, construction delays and cost overruns are a recurring theme. When people get reports, we get a lot of questions around this. How much of this is sponsor execution versus there really are market forces outside their control?
I'll try to answer that. So I would say the majority of the situations, these are market conditions. We're dealing with the interest rate environment and everything else that we've discussed today that are causing these projects to be delayed, to be over budget. bottom line is there've been these projects have been hit from a lot of different directions. That doesn't mean every single developer hasn't made mistakes. That certainly happens, but I would say the vast majority of our situations can be, there's reasons and rationale that are tied to the market rather than we don't know what we're doing.
That's good to hear. Another question that probably is based on a lot of things that people have been reading in the paper. Are we seeing international investor activity influencing the US CRE market, either positively or negatively?
I would say, I mean, one, I'd say potentially there's some negative in terms of international capital flowing in. I think, that's always been a space where international capital has invested a lot is commercial real estate in the US. I know one example that comes to mind was a deal that was on the platform, was looking to get refinanced by a Canadian lender. And kind of when the whole tariff situation arose, the lender pulled out due to those reasons, right? Just due to kind of international policies, which obviously left the sponsor in a bit of a bind, but they're able to find another domestic lender here to kind of fill that gap. But it definitely is having a factor kind of on the real estate market, I would say.
Yeah, the timing on that deal with the Canadians was not good at all. It was almost like that was kind of the height of the Canadian US
Oh,
uh,
yeah.
when that loan was scheduled to close, and it killed the deal. So
Here's an interesting one. Do you see alternative housing models such as Tesla's tiny houses having an impact on multi-sector over the next 5 to 10 years? Are they going to be a thing?
I think specifically on the Tesla housing, is my understanding, it's kind of more off the grid, affordable housing, which, you look at the US market and we are very much undersupplied, and in need of new housing coming online. So I think it's something to watch. Do I think it's gonna, have a huge impact? I don't know. My take is I think people still want to be on grid, be, near city centers. So I don't think it'll necessarily compete with kind of urban cores, but potentially may compete, in more rural areas. I'm not sure, Chip, if you have thoughts there, but
um, I don't have anything to. I'm not sure I would disagree with anything you said. I agree. So
Okay, next question is around capital calls. A lot of investors tell us they feel like they're throwing good money after bad. How should people be thinking about them? Chip, you talked a little bit about this. It's a lot of capital calls to keep deals alive. But at what point should they die?
yeah, well, I think there's no correct answer, or there's no exact answer to this question. I think it very much depends. Some cases the capital calls it's good money. It's actually, there's a lease signed with an industrial deal. We need to fund those additional costs, and it actually those dollars will add to the value of the property. But in a lot of our situations, it becomes you really have to understand and analyze the deal, the market, the sponsor. What are they telling you? If is the information they're providing you, I'll call it extremely aggressive. It's on the ability to recover, or are they presenting a realistic scenario where there's a path to recovery? You just need to hang with it. Some deals are in bad shape, and it's more of a desperation play, trying to keep the deal alive so the lender doesn't foreclose. And some deals truly just need capital to carry them for a period of time until there's more liquidity in the market. So,
Any hints for how an investor can tell which is the case in a particular scenario? What should
one of
they
the things we do, one of our processes that CrowdStreet's implemented is sending out these memos from us where we're basically stating the facts of the deal, the capital stack, some of the projected yields on costs, debt yields. And so we're trying to, I'll call it educate the investors so they have the information which will enable them to make the decisions. We aren't able to provide advice or guidance on what to do, but we're trying to make sure that as part of the capital call process, that you have all the tools, all the information in place.
yeah, I would agree with that. I mean, I think the approach is to view the capital calls. You almost have to re-underwrite the deal, understand, you know, what is this additional capital being used for? What's the status of the underlying deal currently, what are the market expectations kind of, Chip, as you laid out, and you know, it's a new investment decision, and you really have to take the time to do the work, to make an informed decision there.
And then one question that we get, another one we get a lot in the IR. Um, the CrowdStreet marketplace has been very slow. Can you speak to why? And, is that a reflection of the market? Is it a reflection of the way we're changing the way we're doing things?
I think it's a very real reflection of the market. I mean, look, as Chip talked to, right, transaction volumes are very much down, you know, compared to where they were. So not as many deals are happening. And I think, you know, having a deal that, you know, makes sense in today's market is a lot harder than what it was, you know, in the previous cycle, right? Capital is harder to come by. You know, debt is harder, costs have gone up. But that being said, I think, you know, we've seen that kind of that reset in basis, which is a good thing. But you're also, you know, if you look at deals, I think I also hear from investors, Mary, that, you know, where are the distressed deals? There should be distressed deals, right? You know, the data says that there's only about 3.4% of deals that are transacting are actually truly in distress at this point. So there's actually not a lot out there. And I think we've also seen that sellers who are bringing their offerings to market aren't necessarily transacting and waiting for, you know, uh, to go to the market later because they think, you know, pricing may increase. So I think it's a combination of things. I think we're being selective, and you know, there's less transaction volume on the marketplace. And I think also I would say what we've seen too is that, you know, as investors are dealing with capital calls and everything else, there's also just less demand from, I think, retail investors to be investing in commercial real estate. So I think it's a combination of a lot of things.
Following up a little bit on that, how do we stress test deals? And how has that changed since 2021?
So when we stress test deals, I think we're coming at it from a lot of different angles. I think we are looking, okay, testing different assumptions, whether it's rent growth, actual rent collected, vacancy, you know, exit cap assumptions, and running different scenarios of, okay, if X happens, what is the effect on Y? And I think ultimately, as I mentioned, I think a good way to look at it is if we go into a deal today at this pricing and nothing happens, can we service the debt, and hold the property? Or are we going to run into trouble, right? It's identifying what down the road is going to potentially need a capital call and what needs to happen for, you know, more capital to be needed, in a deal. And is there enough kind of capital reserves to have the deal carry through the business plan if certain factors happen
Yeah,
that
have they considered what can go wrong and
exactly. 'Cause
planned accordingly?
I think it's important that when you look at an offering, that is underwritten with a pro forma, I'd say 100% of the time that is not what's actually going to happen in the deal. Something's going to be different, right? That is not what is going to happen. So I think you just have to kind of come at it from a lot of different angles.
Okay, here's a question that is very timely for what CrowdStreet is up to. Recent regulatory changes have increased the flexibility of 401k plans, giving individuals more opportunity to diversify into alternative investments. From your perspective, how do you see this shift affecting capital flows into commercial real estate?
You know, I think it's kind of builds upon what we've done at CrowdStreet here already, right? I think it's providing more access, to, you know, retail investors to move into the space through platforms such as CrowdStreet, right? I think it's still, you know, tough to get access to individual real estate assets, but through platforms such as us, that becomes a possibility. I will say I do think it's just so important to make sure investors such as yourselves kind of have all the tools and education to make those informed decisions. So I hope, you know, today's webinar kind of assists with that, and hopefully we can put out more content to kind of help educate those investors who may be new to kind of going into the space. Because, right, I think it's important to remember these are kind of highly illiquid, risky assets that can offer, you know, upside. But I think it's important to understand kind of all the facets of the investments that you're making, especially for investors who are kind of new to that space.
All right, we are just about at time. Are there any last words of wisdom you want to share with the group?
To me, I think when I look at cap rates and kind of where rates are now, it feels like we're normalizing and getting a bit out of the craziness that we went through. So still a lot of uncertainty and volatility in the market ahead, but I think we're heading towards normalization and kind of a new cycle.
All right, with those words, I will thank everybody who joined us and thank Chip and Anna Marie for being our panelists and giving us such a great session. We did record this, so we will hopefully be able to get this out to people who want to hear it again or who missed over the next couple weeks. So thanks very much, and thank you everyone who joined us, and have a great day.